All right. So super excited for my guest today. As our platform is evolving and helping fund managers become institutional, right? So we have fund managers that come to our program that start out as angels. We have some people starting out on fund one, kind of thinking about how to graduate to fund two. So I have one of the perfect people to go deeper on that topic. So we've got Matthew Bobrow. He is at Nixon Peabody. He runs their private funds group. He's already mentored several people in my program, just kind of helping them rethink, how to become institutional so that LPs will kind of take you seriously. And, that entry point could be different for everybody, right, Matthew? I mean, depending on their background, kind of what their goals are. So
Absolutely.
number one, want to welcome you to the show, and, excited to go deep. So thanks for making time for us in the community. So why don't we start with your background, your career? I think some people might be interested also in just kind of the legal career pathway and the legal profession, and walk us through kind of how you landed into the private funds group, because I'm sure you'll have more insight on this, but when you study law, there's probably specialties or fellowships or kind of more deeper programs that you can specialize in. So tell us kind of what made you, walk us through the career and then walk us through kind of the decision to focus on private funds and what you're excited about.
Happy to do that. Thanks for the introduction, Joel. So I went to New York Law School in New York, so I have pretty deep roots in New York throughout law school. I did a lot of things for different businesses in New York. So I'm pretty much, Giants fan, Yankees fan, New York through and through. I live on Long Island right now, but I'm in the city like 2 or 3 times a week. If anyone wants to meet up, talk about anything after this. But so I after law school, I got into 2 big investment banks, and I was doing more regulatory legal compliance work, more with an advisory spin to it, dealing with a lot of the new regulations that came out after Dodd-Frank and sort of the transfer of risks into investment funds away from traditional investment banks who were doing it, mostly before Dodd-Frank. The Volcker rule had a lot to do with that. So after I worked in-house, essentially, which is kind of unique. A lot of lawyers tend to just go into big law right out of law school. And I have this experience being in-house, which I think it's just translated well into kind of understanding the issues that a business is facing from, a risk management perspective, a decision maker perspective, instead of just always opining on the law and never really being able to give that extra practical advice. So I worked at another big law firm after being in-house, and I worked with one of the world's biggest asset managers doing blockbuster fundraisers across the world, some of the biggest in the world, actually. And so I took that experience, and which really taught me pretty much everything I know after being there for years and doing 3,000-hour years in the trenches, just learning everything. And after that, I looked at Nixon Peabody, where I'm at now, as just a place I could go and take that knowledge and really apply it to more of a middle market client base. And also, it's just the LP sign group that we have. It's a lot of government clients, so we're very focused on the public interest at Nixon Peabody. So I'm able to take a lot of my knowledge and really turn it into good. And that's why I'm here too, speaking, looking for just more ways I can help the community.
Yeah, well, thank you for all the support that you've been giving me personally, and also our community of fund managers. One of the things that we want to start talking about are just kind of some of the high level macro trends that you're seeing for different types of fund structures, different types of capital entrepreneurs. So what are the trends that you're seeing for fund managers that are building venture firms, private equity fund managers? I introduced you recently to a real estate fund manager. So what are kind of some of the things that you're seeing across the board in terms of just kind of fund managers trying to build and scale their franchise?
Yeah, sure. I mean, I think there's probably a few trends even across those categories that I could mention, because each investment strategy will have just it'll differ based on the asset class, risk appetite, market conditions, things like that. So it's really, if you look at, say, just real estate funds as a whole, you're looking at less liquidity, you're having longer investment horizons, and that just translates into different fund terms from a legal perspective. From a commercial perspective, what we're seeing in real estate funds is things like shifts to logistics and warehousing, real estate assets, sustainable ESG focused real estate assets like green buildings, right? And, assets in the real estate industry that are just focused on responsible management of their property, right? Beyond just green buildings. So there's also this, they call it like this urban to suburban shift, where there's just the pandemic kind of accelerated people going more into the suburbs. And so you're having more real estate assets there, especially residential retail assets that are just kind of exploding. So, I think you're going to see that shift continue. And just, I'll touch on each of the ones you mentioned just really quickly. Like in the PE space, you're seeing a little bit more of a focus on technology and digital transformation. Like every company that people think are going to be the next big one in their portfolio, they usually have something related to like cloud computing or cybersecurity, right? So those are the trends in the PE space, but that's more industry focused. You also have a strategy focus on these, they're called build and buy strategies, where you're seeing funds come in and try to focus in on one larger company and then sort of bootstrap on smaller investments to that company and just scale it really quickly. And so that's just another really hot trend.
So is that kind of like a search fund at bigger scale? So you're trying to build like a large conglomerate and then, just become the CEO of that company, almost like Amazon, right? Amazon, has made tons of acquisitions, but all of that just kind of bolts on to the footprint of Amazon.
Yeah, I wouldn't say conglomerate necessarily, because conglomerate to me kind of means it could be like a holding company of different types of non-complementary businesses. Whereas these funds, they're usually strategizing so that it's some specific technology in the automotive industry, for example, that they're going to go and try to find companies that are focused on improving that technology. And they'll buy the biggest one, and then they'll get the 4 or 5 others. And it's a conglomerate in that sense. But I would look at it more like a roll-up, like a traditional like roll-up you might see of just different local companies trying to, like, medical offices do roll-ups all the time. So
but they would come in, but it's a little different than a fund, because they're actually coming in and operating that business and then, scaling that business, delivering a return and value creation. And then, on top of that, they're going out and buying complementary businesses to like increase the value of that larger business that owns all those other things. And then that's all rolled up, and then they just sell that as one big, massive deal, versus a fund where you'd raise money for a fund and then you're just kind of buying a bunch of different businesses and then showing your top level returns on top of that, right?
Right. I think that's true. And I think you're seeing just sort of a blurring of the lines where you're having, especially, and this is something I was going to mention later, just people looking for liquidity and secondary opportunities. And so you're seeing situations where the fund term ends and they're selling off the assets, and the people they sell them to are other strategic, investors who are thinking of creating more traditional operating roll-up type companies after the fund already did its, just normal traditional portfolio investing, looking for complementary businesses. So it is sort of becoming more the trend. But
like one example, if we were to kind of whiteboard here, like one example is if you think about like the assisted living business as a whole, right? So there's kind of the residential experience, then there's kind of the luxury amenities that come along with that. So there's probably a different service provider that comes along with it. Then there's the technology, right? There's the sensors, the connected devices that are attached to different parts of the real estate. That's probably another company that handles that. But if you can own that entire vertical with like all of those different technologies and different companies, it would, in my mind, it seems like that could be, interesting because you're just capturing more value. And it's a durable business, right? Because there's always recurring revenue. We're not going to stop dying, right? There's going to be always people that are getting older. So there's like a new cohort of people that you'll continue to have. And then if you own more of those facilities, you get the market share of that.
No, I think that's right. And I think just kind of going along with the theme of blurring investments, just to touch on venture capital funds too. I think one thing you're seeing blur there is these later stage venture cap funds where they're sort of looking at companies that might have delayed going public or looking for bigger investors, and it sort of has the look of a traditional PE fund with traditional PE terms. But then you take a look under what the investments are really, looking to make, and you're starting to see, oh, maybe this is a venture cap fund. You look at the time horizons for those investments, and you're like, well, yeah, it looks more and more like a venture cap fund. And so you're starting to see just different elements that you would traditionally see isolated in one or the other kind of happen in both now. So, that's a huge change, I think, and just even the diversification, right, that you're seeing in impact investing. Like, I think that's kind of caught like one of those factors that you used to see more earlier in the venture cap space. And now it's like, no, like we're middle-sized, larger company, and this is the main thing that we're focused on. And so you're just having these different elements kind of blur more together, I would say. And just to focus too on, cross themes across these different strategies. I think ESG, we hit on it, like I think for two of them already, but pretty much across asset classes, investors are just asking the questions around ESG, regardless of political affiliations. They kind of want to know, just kind of get that information from their managers. And liquidity demands, like that is something that I think might be creeping up further just based on the market, but also there's just more options out there. Like people are getting a lot more creative with how to, like we were just talking about, right? The roll up after the fund that's focused on a build and buy strategy. And so you're seeing more of this liquidity be created out of just people being creative. So I think that'll continue. And just the final thing I'll mention that we didn't really touch on is just global diversification. Like you're seeing more of these funds that were traditionally in the United States looking at real estate assets, for example, look globally, look at emerging markets where the return might be a lot higher, and maybe they'll blend a portfolio of different assets and try to hedge their risk in different ways doing that. So you'll kind of see that more and more, I think, too. But that's just sort of like the quick hits on trends in those different areas you mentioned.
I mean, so let's talk a little more about just kind of building a franchise. So like I've seen some really innovative capital founders, right? So I've seen some founders that obviously, they know that this is what they're going to do for the rest of their life. This is their legacy, right? So I almost think of it as like building the next Blackstone. So I've seen funds kind of have really great visionary ideas to kind of be able to offer products that could delight their customers. So I've seen some funds kind of, now they're on like fund 3, right? And they've developed they're not in real estate. They have a venture fund, but now they have a growth equity type of offering that's not early stage. And they go out and raise another parallel fund for that. But then I've also seen some of these funds also come out and do a real estate fund, where they actually, do some real estate development. They're actually, offering some real estate products that could be really interesting for maybe some of their LPs that are family offices that maybe started out in the real estate world and now they're offering that product, right? So, I mean, if you think about like Blackstone, right, they have PE offerings and they do a lot of real estate. And then there's a blur between real estate, private equity. And then when you think about early stage, some of those deals are evolving to growth equity. And then there's a blurred line sometimes with growth equity and PE, right? So it's kind of interesting to see all of those, not only stages and, fund sizes evolve and like, having people run parallel fund strategies, but also just actually add other product offerings. So I don't know what your reaction is to that or kind of what your thoughts are on that in terms of just kind of innovative capital entrepreneurs building franchises that way.
No, I mean, I think that is definitely something that will continue. I think so. I've actually seen more of a sector specialization in the most successful funds and their managers. So, if you're thinking like healthcare, tech, or like infrastructure, like those are managers, like the ones in the top, decile, they're the ones that don't have like a side real estate fund too. They're focusing all their attention, all their network on that one specialization.
Sure.
I think if you're in a situation where you're successful enough to be able to kind of take that advantage that you've had in that sector and apply other elements of an investment management business to a new sector, and you're really looking at a whole new investment strategy, and there are other elements to your business beyond the investment strategy that, if you're highly successful at, will easily translate into a new investment strategy. Like, for example, your investor relations, right? Like, if you are just a really good relationship builder, and you can kind of, tell an investor who is interested in something from one that's not right away, and the guy that's interested in it, and what you have is something he'd be interested in, like, you're going to be good at that no matter the strategy. You're almost just, a relationship management guru at that point. But that's one other element. I think if you look at beyond your LP relations, you have regulatory and compliance knowledge. And so there are certain managers out there that might have worked at a bigger shop and are already ahead in terms of understanding, I need to register as this, I don't need to do this, I don't need to do that, and they're taking that advantage and using it competitively, and they could apply that same knowledge to a real estate fund, a venture cap fund, infrastructure, regardless. And just, the fourth thing, which is a little bit lower, I'd mention really, just in terms of value in that situation, is your operational efficiency, right? Like your back office management, like how incentivized is your team? How integrated is your technology? And, I think if you look at a team that's really just set up to grow based on the investment that was put into them, and you're really successful in one strategy, and then you give them another strategy, they're going to knock it out of the park. And if it doesn't work, it's really just a strategy then, right? So you have all these other elements that can really help you kind of, build up to another level of asset manager. But I would try to advise clients to focus in on those specific things and make sure you're good at those things before trying to just say, I'm okay at this, let me try this. Like, make sure you're really, really good at the first thing, and then, start thinking about a new strategy. But
I've seen GPs, to piggyback off of that, I've seen solo GPs do like a $25 million fund, and they're thinking about fund 2, and it's the exact same portfolio construction. So they're really just they have this flywheel, and it seems like it's working because their second fund is the exact same size, and it's around 25 million. So I guess what do you think people should think about if they're raising a second fund for a larger amount? So like if you're thinking, I always think it's a red flag if if you had a $20 million fund and you only raised 4 million out of the 25, and now your fund 2 is like 80 million, because there's a huge disparity from, number one, the size of your first fund, and then on top of that, like how much you actually closed from your first one that you tried, and now you're going out to market with an $80 million fund. So kind of what's some advice you'd give to fund managers in this market, and then we're going to talk about marketing later, but just kind of thinking through the ideation of building that firm. And then, if they've kind of gone beyond fund 2, how should they be thinking about, gone beyond fund 1, how should they be thinking about kind of formulating the vision for fund 2?
Sure. I think the most important thing is to think about it in terms of track record versus vision, right? Yeah. And you have a fund 1 that has a strong track record, you're going to easily hit your target investment raise, and you're easily going to get to your fund 2 targets as well. So if you have a situation like what you described, where you were looking to raise 20, you got 4, and now you're telling me you're looking to raise 80, of course it's a red flag. Like there's no track record, right? So then it becomes the vision. And it's,
Yeah.
well, what's your vision for this new fund? Like, it's clearly not going to just be the same thing, right? And if it is, then there's no real vision there. And it's essentially just somebody who's saw something, tried it, it didn't work, and now he's trying to do it again. But if you have a situation where you have a track record after fund one, I think that is the most crucial element of getting a successful fund two. And you really have to highlight your early wins. Like there's a fair and balanced disclosure requirement in the SEC rules, but you must put your wins. You can balance out all the losses too, but don't forget to put the big wins from your fund one. And I think just be transparent about the challenges that you think you're going to face in fund two. And this kind of goes to, it's a broader point, but just the alignment of interest with your investors. Like even in fund one, right? But in fund two, especially, when you're, say you had some challenges in fund one, and maybe it's the person that you're describing, you kind of just need to be transparent. Like what happened in fund one, right? Like why didn't you get to 20 million? And like, now why are you coming to me with this? And like, maybe that'll help build a vision for it. But that's kind of the main crux of it. But I think if you're in a position where you are doing a fund two, you need to look at your investment strategy. Your investment thesis is going to evolve from fund one. You're getting a bigger commitment size most likely. So that means thinking about things like, am I writing bigger checks or am I doing more deals? And just being strategic about which and why. And your investor base will also grow. You're going to be dealing with more sophisticated investors that might want different types of disclosures. So you just kind of have to be conscious of, again, aligning interests. So, the obvious points are building your LP investor base from fund one into fund two. Like I was saying before, if you're a really good relationship manager, you need to just double down on that and say, look, we have a super strong track record. This is why we're changing things and going bigger. This is why we think it's going to work. These are our challenges. You're being very transparent. And, I think if you can do something like put skin in the game, I think is kind of my final big point on this is, in fund one, you don't really have that ability. Usually, you don't have a successful, fund to say, hey, I'm going to put 20 million in and now I'm going to get 40 million of other investor capital. You just are kind of starting from nothing, right? So you might have a little bit if you're lucky, but sometimes you don't. And I think it's really key in fund two. If you had a successful fund one, investors are going to say, why isn't he putting up or why isn't she putting up capital now and putting skin in the game if they were so successful and believe in the strategy? So, and that's kind of tied into the other points. Like your more sophisticated investors are going to be the ones pointing those things out.
Yeah.
But yeah, that's kind of the key differences, I think. But yeah, I think one other point I just don't want to forget too is you're going to have more negotiation power. Like everything I've been talking about has kind of sounded like more work, but this is kind of the icing on the cake part where if you had a really good fund one, this is the time for you to say, this is our strategy, these are our challenges, but we did really well. We think we're going to do really well again, so we're going to raise our fees a little bit. And that I think is just acceptable. So, just keep that in mind. Just be reasonable with your investors. But does that kind of cover
I've seen people. Yeah, no, that was really helpful. And I've seen people have higher fees in the beginning. And what they did is they were able to justify those fees using their budget. So they have a financial model kind of managing their burn rate and kind of showcasing how much they're going to, how are they going to operate their fund, right? So usually I think it's helpful to maybe partner with a CFO and kind of just, forecast out like, hey, this is my, I know I'm taking 2%. I'm going to, out of the 2% every year, this is how I'm going to operate my business. I've had fund managers actually take some extra capital out of the management fee and deploy that into getting into a few more portfolio companies to hopefully get a little more alpha. So I think that really shows true dedication. Before we get into kind of a checklist or kind of just hot topics that managers should think about, what are the LPs telling you? So, it could be definitely confidential. It could be, we could just kind of not name names here, but are there hints of just kind of commentary that you're hearing from the LP community? I know you guys have some really great people in your network, but any kind of reactions to the market, things that, LP shared in terms of like why they passed on a fund, that might be just helpful data points to keep in mind.
Sure. I mean, I think there's the usual, from like last night's debate, that I think people have, certain ideas about which president is going to lead to which types of investments growing and going down. So I think that's kind of just a given. But I think beyond that, investors are really focused in on successful managers that in Fund One, I think conveyed a vision that didn't just happen to be lucky and like turn out the way that everyone hoped. It was more the exact way that manager described it. Like, we invested in these exact companies. We don't have to come back to you and change our thesis. I'm really still focused on that Fund One manager there, but on later developed investment managers, I think your LP base is really looking to find fund managers that are looking to align interests. I think that's, the main point there is, if you have an investment manager and he is willing to talk to the investor and say, this is the issue you're facing, maybe it's reporting, maybe it's a concern about returns, maybe it's a portfolio target, that they don't think is right, like maybe it's a certain class of investment they don't want them to be in. I think you're going to find there's really creative ways of working through those issues, especially with sophisticated investors. So, a lot of them are just turned off when somebody's just like not responsive, or, just maybe not really thinking through those creative alternatives, and is maybe just assuming that it's not a good fit off the bat. I think from an industry perspective, like when you're looking at what are the industries where investors are the most focused, it's the cloud computing, biogenetics, especially related to real estate assets, like life science real estate assets are some of the hottest we've seen. And I think kind of just the real estate space isn't necessarily as a whole, or venture cap space as a whole isn't, fundraising at record clips by any means, but you are seeing these hot pockets like data centers on real estate, where you are seeing enormous investor interest, and it's having the effect of going up the supply chains to like the mining companies in Canada that produce some of the rare metals that go into the data centers. You're seeing, venture cap funds that are focused on certain rare earth metals in certain specific regions. And those are specifically catered to the investors that have those broader theses. Like, I'm a government investor, right? I'm trying to incentivize a whole new economic model based off of new technology. I'm trying to have my country be disruptive. Like, they're focused on these industries in a very specific way, so that we're seeing investors are like I mentioned at the beginning, some of our biggest investors are government investors. And so they are across the United States. And so they will look at different emerging technologies in their states. And that is kind of specific to the state. So say you're in the Midwest, maybe it's agriculture-based technology or energy-based technology. But that is the hyper focus that they're looking at. They really want to get into those sectors. So I think that hopefully that paints a good picture from industry focus to even a manager size, things like that.
Yeah, I mean, I think the industry strategic insight really helps. So a healthcare system may have some serious advantages from investing in funds that have a specific strategy, improving the healthcare IT stack. Right. And like maybe there could be some strategic P&E opportunities for that, whether it's a family office that runs a healthcare system or just a healthcare system as a whole. There could be some strategic acquisitions that come about, or even just direct investments into those companies to solve problems of like the hospital system as well. Right. So because they probably don't have a tech transfer department natively within the system. So they have to leverage kind of these partners that are venture funds that are on the pulse, going to every single conference, kind of sourcing and screening deals every week, which the hospital system doesn't have time to do because they're trying to keep their beds full, right? So
right. I mean, I will mention though, this is a constant stopping point in the discussion. These investors, they still have fiduciary duties, right? Like if you're a pension fund or you're a hospital system, you can't just say, well, I'm going to invest in this. Like I'm a union pension, so I'm going to invest in the thing that my union works on, right? And like, assume it's going to necessarily be a good investment with good returns. You're kind of breaching your fiduciary duties. So what you really have to look for is someone who's strategically investing. So, if you're sprinkler union, right? I'm just making this up. And you're looking at target investments in sprinklers, but you're also broadly investing in other industries, right? Like you're satisfying your duty. So if you have a manager, right, and say you're on fund 2, fund 3, you're finally talking to somebody that's like a pension system. It's not necessarily a winner to just say like, we'll change some of our investment thesis to go into like housing for the people that are part of your pension. But maybe it's a winner to say, well, maybe we'll look at investments that could actually benefit the beneficiaries of your pension. That makes sense. Real estate is kind of like random, but you do sprinklers on a sprinkler pension, maybe you're satisfying the fiduciary duty because you have that industry knowledge into that sector. So you're kind of justifying it in that way. So you kind of just have to be a little strategic on how you approach investors on these points. But pretty much every investor that's looking at an emerging manager, they're willing to be flexible. So you kind of just have to be creative in how you take advantage of that flexibility and make a deal that works for everybody and aligns the interests.
Sure. And, I know you had kind of a little bit of a checklist or just kind of hot topics for emerging managers to think about. So on the manager side, what are kind of the top pieces of advice that you would give them to just think about top of mind as they're building their firm? And I would say anywhere from, raising capital and closing capital, getting people on board, all the way down to, I would say, if I'm thinking about the end-to-end work stream, it's also just portfolio support and then just back office, making sure they get all their K1s in time.
Okay, yeah, no, definitely. So let me just tell you the top 5 and then maybe I'll go into more detail. So totally right. Like get a clear investment thesis and strategy. Like that is number 1. Like you can't go anywhere without that, right? So you get that done. And then, so number 2 is your strong LP investor relations. You really need to be the same way you're really, one of the best at picking opportunities in a certain market. You need to be one of the best at talking to investors and showing them transparent communication, like what I was talking about, like being transparent with your challenges, managing those expectations for super high returns. Like you don't need to put in a super high, expected return number 3 years down the road from now in your pitch deck. That's not something that any investor really needs to see, and it isn't going to help managing expectations.
Sure.
But I think your regulatory and compliance knowledge is number 3, operational efficiency and just capital deployment and exit strategy is kind of the 5th point there. But let me just say one thing about the clear investment thesis and strategy. I think what goes into that is not just a well-defined thesis, focusing on what you're in, geography, sector, stage, all that good stuff. But your adaptability to market conditions, right? Like you need to be able to know if this happens in the market or if it goes the other way and that happens in the market, how does that affect your thesis, not just your return, right? Your thesis, your broader thesis, and how are you going to even take advantage of those changes in market opportunities? So, I think that's one thing that I'll ask managers sometimes, and they'll have a great, we're going to invest in this or that. And I'm like, well, what if this happens? And they're like, well, so you kind of need to make sure that's clear. And just the last point kind of on the back office is risk management. Like you really have to be intelligent and I would say hyper analytical and even cross portfolio risk. You're going to have to think about not just your portfolio risk, but Like we were just talking about market risk. You have your credit risk from different lenders you might be taking on, and just how the market risk interplays with the credit risk. And, I think taking off your investor hat and taking off your investment management hat with your investors, right? Putting those aside and just saying, like, let me take a step back. Let me think about, what if this happens? What if that happens? Let's be smart about making sure we have a plan. I think it's really core to any business, right? Like even if you're just like a vanilla retail shop. But in investment management business, I think it's a competitive advantage. Like if you're able to do that well, you will see, lower costs. You'll see lower overhead. You'll see less losses from, those one-off risk events. So it really can be used competitively.
What are some of the biggest? No, go ahead. Sorry.
No, that's it. No, please go ahead.
Yeah. No, it just popped up in my mind. I think another hot thing to talk about is just top mistakes that you're seeing. So like, or just kind of things that, should be avoided. What are just kind of things that you're seeing in the market that managers are not to, we talked about just kind of not telling your story right in terms of like how you got from 25 to 80 million when you've only closed a fourth of that. So that's definitely like, strategy and storytelling issues. What are some other just challenges that, or just kind of mistakes that you're seeing managers make that you think just new managers should be just aware of because it might help them, right? They're like, oh, wow, now that Matthew told me this, I should be careful about that.
No, absolutely. So I think the really there's maybe two things I'll focus on the most in terms of just biggest mistakes or easy foot faults, maybe I'll call them instead of mistakes. But just having a clear exit strategy. I think that's one thing I think a lot of early stage managers might miss, and that kind of ties in everything else we talked about, from the different risks, from credit risk to market risk to dealing with investor alignment, and just be transparent in the opportunities there, given that exit opportunities aren't necessarily.
And is this for the portfolio company level as you're making each investment, just kind of having a vision for like what that exit could be? Or also, I think it could also be just for the fund, right? How do you fully deploy the fund and actually deliver some type of multiple or, hopefully even just get into DPI? When you're talking about that, are you talking about both layers or just one more deeper?
Yes, generally speaking, both layers, just because you can have different funds that are sort of playing in different sandboxes. But I think from the portfolio company level to the fund level, it's really important. Like, so, if your strategy is like more focused on the buy and build, strategies, right? We were talking about, then it is more of the portfolio level. Like we need to focus on how we're exiting, say 3 or 4 different companies that are doing similar things, at similar times, that raises concerns. And so, I think it's the issues I've seen, I think are part and parcel to the trends that we talked about. So, you see more buy and build strategies, you see more people missing how the exit opportunities could become an issue. And so you then at the fund level too, right? Like if they're selling off to do a roll up instead of just selling off to do something else, like what's your fund 2 look like? You're going to have to come up with a new investment strategy and kind of think about, well, what am I doing, right? Like what's my exit strategy from this business and how do I get into a new one, a whole new investment strategy? So it's sort of multifaceted, but it's kind of just conceptually, I think the idea of just thinking through your business plan, like from point A to Z, and not just from your investment level, not just from a fund level, but really from a management company level too, from a personal level, and making sure all those dots are lined up and the timelines line up right. Otherwise, you might have some unhappy investors.
Yeah. And then we talked, over cocktails, we talked about insurance, right? So when should managers at what stage kind of seriously think about like, D&O insurance, or what are the type of policies they should get as they're kind of growing their firm? And obviously some small managers don't have the budget, even within their management fee to pay for insurance. And then I know some fund managers that pay probably $100,000 a year in just, insurance.
Sure.
So just kind of, how should just asset managers think about that?
Sure. So, it's sort of a broad question because it's essentially saying, like, how do you think about risk? And I think what you'll find is there's just different appetites. And when you are an earlier stage manager, fund one, you have a small investor pool, maybe half a dozen investors, maybe to a dozen. You have maybe 6 portfolio investments, and you're not the biggest one. You're not the biggest investor in any of them. You're probably one of the medium-sized or smaller investors. You're not taking controlling stakes. Your risks are limited. So your overall likelihood of needing that D&O insurance is much lower. Than somebody who's, say, on a fund 2 or a fund 3 or diversifying strategies, getting into things that maybe they haven't gotten into before, but they have a big money bag now that some investors or somebody with a claim might like to come after. That's kind of the obvious case, right? Like, we've been successful, we're going off and we're taking some new risks. This just is a no-brainer, and maybe that's the $100,000 a year situation you were describing. But I think that would be a situation to me where it would make sense to take those costs on, just because it's, why have that be something that you have to think about and worry about when you're taking on that much money and you're making investment decisions that you haven't ever made before, because it's a whole new investment thesis. So I think there's not a clear, like, do it now answer, unfortunately. Sure. I think it'll kind of depend on, your personal relationships with those investors as well. Like, if you're in a situation where everyone's interests are aligned, this is kind of the overarching point in all of this, then if something does happen, they're very unlikely to just bring the hammer and try to sue and take one of the directors down. They're more likely to have a conversation and try to understand what happened and try to, not let it happen again. And, because think about it, right? They have an investment and they want that investment to do well, even if there's some bad apple or bad egg. Yeah. And so you don't want to be in a situation of having to pull out that investment if they don't have to. So, I think it's just, those are the situations where maybe you don't need it as much if you have investors that are very aligned with your interests and you're not as worried about, aggressive litigation coming from them if something does happen. If you're pretty confident you're not doing anything nefarious, of course, right? Then it's less needed. If you're going out there and you're raising capital from investors that you've never met, and maybe you met them once on a Zoom, or you met them through somebody else and now they're writing a big check, right? Then maybe it makes more sense. Like, maybe then it's like, this guy, I don't know him as well. I don't know if our interests are actually aligned. I haven't had lunch or coffee or drinks with him multiple times. Then, like, especially because you can get a reasonably priced policy, it doesn't have to be, the biggest policy in the world. So, I think just
and I think this is a whole separate episode on its own in terms of just fundraising, right? Because they've got all these people on YouTube and TikTok that are, like, doing real estate funds. I think they're like retail investors, so I guess they're like 501c funds. But you see people raising on social media now, so I think that's definitely like an area to be careful of, because you don't really know those investors, right? Versus, like, I would say, like, most of the fun ones that I know, their first fund came off the ground from people that they went to school from, the people that they went to school with, or just people in the tech community that are writing maybe 20 to 50K checks, and then that all cobbles together. And then I think we'll have to do another episode on just the new fundraising laws, right? Because now I think you can have up to, 200 plus LPs now, right? Based on the new regulation.
Yeah, there are some new regulations. I mean, there are challenges as always, but we can definitely talk about all that too on a whole other episode. But I did want to mention, though, just the social media point that I would highly avoid doing that. Just as a plug, just don't do that. If you are presenting your strategy and your offering in a clear and concise way, you're aligning the interest with your investors. you're gonna find interest from friends, family, people
Yeah.
in different networks that you're meeting at events and you're talking to. You shouldn't need that, you know. And if you
Yeah.
do need it, there might be might be time to just rethink the strategy. Like maybe
Mhm.
rethink your investor network, you know, rethink your
Yeah.
operational efficiency, like those other
Sure.
key points that we talked about. So
Mhm.
I just I caution it because I see people come to us after doing it, and then we have to
Oh,
kind of
wow.
help
Yeah.
through and
Yeah.
figure out how to
Damage
resolve it.
control.
Yeah, exactly. So on the front
I
end,
mean,
it'd be
there are
great.
fund managers that I've seen do it, just building valuable content on Twitter. And, I think they're, classified as a 506C. So just through creating, valuable content, that helps to educate. I feel like education is a really great way to build goodwill with investors. Cause I mean, especially if they're investors that have never invested in venture and they come from like a manufacturing or logistics or real estate background, they've never really gotten into the tech space. They've just only known logistics. So now they kind of come across you coming in their feed, and you're just sharing like, hey, here's 10 trends that are happening in the AI space if you're like a venture fund, right? So then that's kind of interesting content to consume. But I don't necessarily see those managers going out saying, hey, I'm raising, if you want to invest in my fund, click this link.
Well,
I don't see it as blatantly obvious.
I think this is a good conversation to have because it's really kind of the crux of a legal issue. And we
Yeah.
have, I mean, it's a highly analytical point and it's fact
Mhm.
intensive, and so I can't really give a true legal opinion, right? But
Oh,
what it
sure.
really,
Yeah.
yeah, sure. But what it really comes down to though is, do you have a reasonable belief that this investor is essentially who they say they are as an eligible investor
Yeah.
under the law? And if you are
Mhm.
putting, say, like the name of your fund and what you're doing and how much you're raising and
Mhm.
just on a website, and all that information is just publicly
Yeah.
accessible, that
Mhm.
is essentially a public offering. And
Yeah.
you kind of want to avoid a situation like that. You
Sure.
because what could happen is the investors come in, the sophisticated ones later, and they look at how you've been marketing, and it kind of taints the whole vision, right, that we talked about for
Yeah.
your fund, how you've been, knocking it out of the park and everything's been perfect. Now there's
Hmm. Sure. Yeah. Hey, Matthew, I think you froze for a second. So we'll try to see if we can get Matthew to come back on. But I know we're at time, so if he can come back on in a few seconds, if the video restores, we'll wrap up. If not, hey, really enjoyed everybody's time and really appreciated Matthew from Nixon Peabody coming on, and we'll try to catch up and do some other episodes talking more about private funds and yeah. So thank you everybody for your time. Really appreciate it. We captured a lot of amazing content. So thank you again. Catch up soon.